If you take out a $300,000 mortgage at 7% over 30 years, you will pay the bank $718,000. $418,000 of that is interest. That's more than the house itself. But here's what almost nobody tells you. The most important part isn't how much you pay, it's when. Because in the first 10 years of a 30-year mortgage, you are not buying a home. You are paying the bank for the right to live in its property. The math behind the American dream. And once you see it, you can't unsee it. 3 things in this video. 1. The actual math of a standard 30-year fixed mortgage, not approximately, to the dollar. 2. A concept called front-loaded interest and why every conventional mortgage is engineered this way on purpose. 3. What you actually own after a decade of payments. Spoiler, it's almost nothing. Let's run a real scenario. The median American home in 2024, about $375,000. 20% down, that's $75,000 out of pocket. The mortgage itself, $300,000. A 7% fixed rate, which is roughly where rates have lived for the last 2 years. 30-year term. This isn't an extreme example. This is the median family today. The amortization formula spits out a monthly payment of $1,995.91. Round it to $2,000. You pay that $2,000 every month for 360 months. No skipped payments. No early payoff. 360 payments times $1,995.91. $718,527. You borrowed $300. You'll repay $718. The difference? $418,000 is what the bank charges you for the privilege of using its money. For every dollar you spend on the house itself, you spend $1.39 on top, paid to the bank. That's not buying a home. That's a financial product with a house attached. Here's where it gets interesting. Not how much you pay, when you pay it, and what you're paying it for. There's a term in finance called front-loaded interest. It means exactly what it sounds like. The interest is loaded into the front of the loan. This isn't a glitch. It isn't a sneaky fee. It's how every standard amortizing mortgage is mathematically built. Look at your very first payment. Out of $1,995.91, $1,750 goes straight to the bank as interest. Only $246 reduces what you owe. That's 87.7% of your first payment. Not buying the house, renting the money. Imagine the house is made of 360 bricks, one for each payment. In your first month, you don't buy a brick. You buy about 1/8 of a brick. This is the amortization curve. Every loan officer in America knows it cold. Most homebuyers have never seen it. The red line is what goes to the bank each month. The green line is what goes toward the house. And notice, they don't cross until year 20. Now let's talk about year 10. Because year 10 is where most people lose. After 10 years, 120 payments, you have given the bank $239,500. Of that $250,000, only $42,000 reduced your loan. The other $197,000 was pure interest. Money that is gone. Money that bought you nothing you can sell. After a decade of paying your mortgage on time, every month, you still owe the bank $257,000. You've paid down 14% of the principal. Here's the comparison nobody runs. A renter paying the same monthly cost for 10 years walks away with nothing. A homeowner paying the same monthly cost walks away with about $43,000 in equity, minus the down payment they put in, minus closing costs, minus property taxes, minus maintenance, minus the realtor's 6% when they sell. In the first 10 years, the difference between renting from a landlord and owning with a mortgage is much smaller than the dream suggests. The bank is your landlord. The house is the collateral. And here's the kicker. The median American homeowner sells before year 14. Most Americans never reach the crossover point at year 20. Most Americans spend their entire mortgage term in the front-loaded part of the curve. None of this is an accident. The 30-year fixed-rate mortgage is not a law of nature. It's a specific financial product designed in a specific decade for a specific reason. Before the 1930s, most American mortgages were 5-year balloon loans. The Depression broke that system. The federal government built a new system, the Federal Housing Administration in 1934, Fannie Mae in 1938. From the bank's perspective, this is the perfect product. They lend you money. You pay them interest for 30 years. If you default, they take the house. If you sell early, you pay them off, and they recycle the money into a new loan with someone else. Now, the honest part. There is a case for owning. A mortgage is a hedge against rising rents. Your payment is fixed for 30 years. Your landlord's rent is not. A mortgage is forced savings. Most people don't have the discipline to invest $2,000 a month. A mortgage payment makes you do it, whether you like it or not. And owning means stability. You can't get evicted because the landlord wants to sell. You can paint the walls. There's a value to that which doesn't show up on the amortization schedule. The case for buying is strongest when 3 things line up. You plan to stay more than 10 years. The mortgage payment is roughly comparable to renting the same place. And you have enough cash that an emergency doesn't force you to sell at the wrong moment. If those 3 things aren't true, you're not really buying a home. You're paying a bank to hold one for you. The American dream wasn't a lie, but it wasn't a gift either. It was a financial product. You're not buying a house, not in the first 10 years. You're renting money from a bank with the house as collateral. That's not necessarily wrong, but you should know what it is before you sign, because the bank knows. If you want to learn more, make sure to subscribe to the channel.